All right, welcome to the Accounting 651 video lecture on corporate formations. We're going to do this in two parts. This is part one, and then we'll take a little break and go on to part two. All right, so let's start with 351 in general. So Owen decides to form OpCo, Inc. He's going to transfer property. That property has a value of $100 and a basis of $10 to OpCo in exchange for stock with a value of $100. So Owen is going to realize $100. His adjusted basis is 10. That means he'd have realized and recognized gain of $90. OpCo would have $100 realized. It costs nothing. They have no basis in their own stock, and therefore they'd realize and recognize a gain of $100. So there would be a tax cost as a result of simply a change in business entity structure. So what we want is we want to have a neutral effect on the organization of a business, right? So as part of the tax code, underpinning that fundamentally is this idea that you should be able to organize and get out of business in more or less a tax-free way. So we need a tax rule that prevents this exchange from generating realized and recognized gain, or recognized gain at least. And there is one. So under 351A, non-recognition treatment is applicable to the asset transferor if conditions are met. Otherwise, there's gain recognition. And for the corporate side, there is tax-free treatment to a corporation that issues its own shares in exchange for cash or property. So what happens is the cost of that in general is that the tax basis is going to carry over for both the shares and the assets to the shareholder and the corporation. And do not worry, we're going to go through this in detail. So 351A, what are the specific requirements? One or more persons must transfer property to the corporation. The transfer must be in exchange for stock of the issuing corporation, not securities. And the transfer group must be in control immediately after the exchange. And it's not permitted to be an investment company, which, no kidding. So what income tax objective are we trying to achieve with this treatment? And what we're trying to do is avoid sale treatment, right? So this is similar to a like-kind exchange. And I'm assuming somewhere along the way you guys have covered a like-kind exchange. If not, you'll get there if you're in 624. But if you took an undergrad tax course, you should know that like-kind exchanges generally are treated as a non-recognition event. And that's kind of what we're after here. And what would happen is the more closely it resembles a sale, the more likely you're going to recognize some form of gain. And sure enough, 351B says, well, wait a second, if you get something besides shares, if you get stock, then we're going to make you recognize gain to the extent of the boot that you received. So you get cash back instead of stock, there's a gain. Code section 358 says the basis to the shareholders, so the basis of the stock they're going to receive in this newly organized corporation will be the same as the basis they had in the property they transferred. And what happens is that creates the potential for double taxation of the income, that is taxation to the corporation and the shareholder. So again, here we have Owen deciding to form OpCo. He transfers the property, $100 value, $10 basis, in exchange for stock with a value of $100. If the basis carries over, then Owen's basis in the stock he now holds is $10. That was his basis in the property. And OpCo's basis in the contributed property, so the assets they received, is also $10. Therefore, the unrecognized gain is preserved. But in the situation where Owen held that property himself, if he had sold it, he would have recognized a single gain. In this situation, if Owen sells the stock and OpCo sells the property, they both will generate a realized and probably recognized gain of $90. So think of this as preserving double taxation, right? And some people call this the lobster pot because once you get in, you can't get out, right? So the idea is this is what corporate taxation is all about, is double taxation. And so, yeah, you contribute appreciated property to the corporation. That double taxation is created and then preserved. So Owen could have sold the property and paid tax on the single gain and then contributed the after-tax proceeds, but he would have lost the deferral, right? So the cost of that is you pay the tax up front. Okay. So 362, the carryover basis for assets shifted into corporation creates a limit on built-in losses. The holding period rules say the transfer has the substituted holding period. So, for example, if Owen had held that property for 10 years, he's treated as now having held the stock that he exchanged it for 10 years. All right. So in this case, Owen decides to form OpCo, except this time the value of the property is $10 and the basis that he has in that property is $100. So he exchanges it to OpCo in exchange for stock with a value of $10. The potential exists for a duplication of the economic loss, right? Because Owen's basis in the stock is $100, OpCo's basis in the property is $100. If they both sell, then in theory they would both generate a recognized loss of $90, and that would preserve double the loss benefit. However, 362E2 provides a limit on the net built-in loss when the aggregate adjusted basis for properties transferred exceeds their market value. So what you have to do is allocate proportionally the built-in loss to the various corporate assets. Alternatively, you could make an election to say the shareholder stock basis will be reduced, and therefore you'd keep the loss at the corporate level. So you still get to keep one of these losses, you just don't get to keep both of them. So what is property? One or more persons must transfer property to the corporation in order for 351 to apply. The transfer must be in exchange for stock of the issuing corporation. The transfer group must be in control. So property is one of the magic terms. It's, of course, not defined in the code. But it has been broadly construed to mean cash, capital assets, inventory, accounts receivable, patents, other intangible assets, industrial know-how. Property can include assets that don't even have a discounted cash flow. So there's some asset out there and you're not even sure it's ever really going to make money. That's okay. That counts as property too. What doesn't count are services, certain indebtedness, and accrued interest. These are not treated as property. So for purposes of this section, stock issued for services, indebtedness of the transferee corporation, which is not evidenced by a security, or interest on indebtedness of the transferee corporation, which accrued on or after the beginning of the transfer's holding period for the debt, will not be considered issued in return for property. So when services are exchanged for stock, the most likely outcome is going to be compensation for those services equal to the market value of the stock. But when services are exchanged, it doesn't necessarily taint the 351 transaction, right? Which is this idea of I'm avoiding sale treatment and I just carry over the basis. So think of it like a reorganization. So stock exchange for services is not counted towards the 80% control requirement. So if individuals C and D each transferred to a newly organized corporation property that has a fair market value of $4,500 in exchange for the issuance of the corporation of 45 shares. At the same time, the corporation issued to an individual E 10 shares in payment for organizational and promotional services rendered by E. C and D were under no obligation to pay for E's services. Okay, so let's think about what's happened. So C and D did a true 351, property in exchange solely for stock. E did not. E provided services. So if we leave E out, do C and D still have control? And the answer is yes, because they're getting 90% of the corporation shares back in return for the property. So as a result, C and D do not recognize gain. E, on the other hand, receives compensation taxable as ordinary income to him for the fair market value of those shares. Okay, so we've got this problem with E, and it's no big deal as long as it's less than 10%, but maybe we would end up in a situation where we might like to get that 10%, or maybe we need that 10%. So maybe what we can do is have E contribute property along with the services. So if shares of stock, both those exchanged for services and those exchanged for property, are both included. So as part of the corporate organization, A contributes property for 45% of the stock. B contributes property for 45% of the stock and also contributes services for 10% of the stock. 351 could apply and all of the shares would be included in the 80% test. So let's take this to the nth degree. So A contributes property for 45%. B contributes property for only, 5%, but then contributes services for 50%. Does 351 apply and all the shares would be included for the 80% test? And there's a revenue procedure that says when a person transfers property to a corp in exchange for stock or securities, and the primary purpose is to qualify for 351 by other persons transferring, the property transferred will not be considered of relatively small value within the meaning of 351-1 if the fair market value of the property transferred is equal to or in excess of 10% of the fair market value of the stock and securities already owned or to be received for services by such person. Okay, so in this case, it would be considered relatively small, meaning it would not taint your 351 if the fair market value is equal to or in excess of 10%. So in this case, the property is worth exactly 10%. So this would actually work under 351. So A, B, and C enter into a transaction that would otherwise qualify for 351. A and B receive 78% of the stock. C receives 22% for a combination of services and property. The property transfers would qualify unless C's transfer of property was nominal or was merely a sham designed to support A and B's non-recognition. So this is the idea, like C's has to be at least 10%. The property needs to be at least 10%. Okay, so a few other considerations. If services were for someone other than the corporation, that's okay. If shares are issued to employees for past services, that's okay as long as control existed immediately after the exchange. And shares issued for know-how are okay unless that know-how was developed specifically for the corporation, because then it's just for services and not for that intangible. Okay, so a transfer of debt to a corporation needs to be evidenced by securities. And that permits a transfer to undo the effects of the transfer of property subject to debt that exceeds basis. And we'll talk about that more in a second. Okay, let me take a little drink. So we have to exchange property for stock. So this mostly relates to intangibles, and because the exchange has to close. So if you grant a license, does that qualify as an exchange? So I'm giving you the opportunity to use my license in exchange for stock. Is that an exchange? Well, it depends. The transfer must encompass the exclusive rights to use, exploit, and dispose of the property within a designated area for the foreseeable economic life of the property. Anything less than that would not qualify as an exchange. So if, for example, I said, look, I own the rights to Dunkin' Donuts, and I'm going to give you the rights to operate as Dunkin' Donuts in a country for 5 years. Those rights could be exclusive, but arguably the foreseeable economic life of the copyright for Dunkin' is more than 5 years, and as a result, that would not qualify as an exchange. I'm basically selling you the rights, and you're paying me in stock, and we would not be able to use 351. So, solely in exchange for stock. We already know that it doesn't really have to be solely in exchange for stock because we know boot can be part of it. You just have to recognize gain to the extent of the boot you receive. But stock represents the continuing interest that the deferral under 351 is designed to preserve. So this represents an equity investment in the company. So we know one thing. Non-qualified preferred stock is not stock. It just has too many characteristics of debt. For example, the stockholder has the right to require the issuer to buy the preferred. If the issuer or a related party is required to redeem or purchase the preferred. If the issuer has the right to redeem or purchase, and it's more likely or not than that will happen. Or the dividend rate on the preferred is pegged to some outside reference that's not earnings related. All those are characteristics of debt, and therefore solely in exchange for stock is not going to work. Stock rights, stock warrants. These are not stock. However, we know that not solely for stock doesn't completely destroy 351. What happens is it just triggers boot to the party that receives something in exchange besides stock. So property with a value of $50,000, basis at $10,000, given to a corp in exchange for $30,000 worth of stock, $10,000 cash and other property worth $10,000. So if we look at column A, we have the amount realized, $50,000. That's what they get. Their basis in the property was 10. The realized gain is 40. The boot they received is the cash in the other property. That's worth 20. So they're going to recognize 20 of that gain and only be able to defer 20 of that gain. Now let's do item B, property with value of 50, basis of 45, in exchange for 30, 10, and 10. In this case, the realized gain is only 5. The boot received is 20, but you only ever recognize as much gain as you realized, right? Receiving boot doesn't trigger additional gain. It just triggers the recognition of gain. So in this case, they would realize and recognize a $5,000 gain. All right. So what is the tax basis for the distributed stock, right? So the tax basis of the assets transferred to the corporation minus the fair market value of any boot received plus any gain you recognize on the exchange equals the basis to the transferee shareholder of the stock received. And that should feel a ton like basis under a like-kind exchange because that is basically the same calculation. Any unrecognized gain remains in the stock. The tax basis limits the total amount of realized gain. Allocation of the boot would be made on a fair market value basis amongst the transferred assets. So imagine that what happens is I transfer cash and... No, I just transfer cash. Let's make it easy. Sorry. Property, not cash, in exchange for shares. And I get back shares and 2 pieces of property. How am I going to allocate the gain to those 2 pieces of property, since I have to adjust the basis by the gain that I recognize? And the idea is you have to allocate that boot based on the fair market value of those assets that you're getting back. The tax character of the gain would be determined by reference to the assets transferred. All right, let's do an example. So the land has a fair market value of $45,000 and a basis of $25,000. The building has a fair market value of $5,000 and a basis of $25,000. So they both have the same basis but very different market values. And let's say that what happens is we exchange this for stock and we also receive $20,000 of boot on this exchange. Okay, so we're getting stock back, must be $30,000 of stock and $20,000 of cash. All right, so when we examine the land, because we have to consider these separately, we say the amount realized is $45,000, the basis is $25,000, the realized gain is $20,000. We allocate the boot between the 2 assets. So the land is 45 of the $50,000 of market value that's received, times the $20,000 of boot is $18,000. So that means we would recognize $18,000 of that gain, and the $20,000 of gain would just be deferred. If we flip over and look at the building, it's actually at a loss. So boot doesn't trigger any recognition of losses. And what happens is, even though there's some boot allocated to the building, there's no loss recognition. And as a result, the entire loss is deferred. So the character of the gain, whatever it is, we'd say, okay, well, whatever the land is as an asset, let's call that a capital asset, because it probably is, we would recognize gain of $18,000 capital, right? The building's a loss and there's none recognized, so it doesn't really matter. The basis for boot is the fair market value since gain recognition is triggered. So if the boot happened to be, instead of cash, some other form of property, then what would happen is we would, the basis you would take in that property is the fair market value. Okay. So boot, exchange property for stock, the holding period of stock typically tacks on. We already discussed that. If multiple properties are exchanged for stock, that actually requires a split holding period for shares. So let's go back and think about that example we just did, the land and the building. Let's say that the holding period for the land was 10 years and the holding period for the building was 5 years. And now I have in my hands some stock. So how do I determine what shares have what holding period? And this is the craziest rule ever. So it's not to say that you would say, okay, well, maybe the fair market value of the shares associated with the land, get that holding period, the fair market value of the shares associated with the building, get that. No, each share has a percent holding period of one and a percent holding period of the other. So in this case, if we got back 10,000 shares and we'd say, okay, well, of the property allocated, some percent of each share is long-term 10 years, some percent of the other shares is 5 years. Now again, since those are both long-term, it doesn't really matter that much. I just think that's a crazy rule. Okay, so what if boot is a corporate note? So you exchange property for stock and you get a note payable back. That note is treated as boot. So this is one of the bad things, right? Even under like-kind exchange, because what happens is you would need to recognize gain. However, if the note is payable under terms, you can use the installment method to recognize the gain on that boot. So A transfers property, fair market value 100, basis 10 to Inc. in exchange for stock worth 80 and a note for 20. So the note is boot, the realized gain is 90, the recognized gain would only be 20. But the regs call for special allocation rules. First is A's basis in the property, $10, is allocated first to the stock. Okay, so that means that the basis A has in that stock is $10. If the transferor's basis in the property exceeds the fair market value of the non-recognition property received, the excess basis is allocated to the installment portion. Now, in this case, since basis $10 does not exceed the fair market value of 80, there's no issue here. And that gain would be recognized ratably as boot is received in much the same way that an installment sale works. So the basis of Inc. stock is $10, treated as if installment sale is elected out of. In this case, the basis of Inc.'s property is the carryover basis and is only stepped up as a $20 gain is recognized. And it looks like I better answer my phone. All right, I'm back from my phone call. Let's revisit this example one more time since I had to rush through it. Okay, so we have a situation where an individual transfers property in exchange for stock and a note. So the note is boot, that much we know. So we need to recognize the gain. But the issue is, how do you recognize the gain on something like a note, right? So that permits you to use the installment method. So what that means is as they pay you on the note, they pay you the principal on the note, you would start to recognize the gain a portion with each payment, just like under the installment sale method. So what do you do with that gain? Because remember, gain affects the basis that you take. And basically what this is saying is, look, if the A's basis in the property is allocated first to the stock, right? So in this case, it's $10, and that means that his stock is worth $10. And then the excess basis would be allocated to the installment portion if, but only if, the fair market value of the non-recognition property received was greater than or was less than the basis, and that's not the case here. So gain is just going to be recognized ratably as boot is received, and as a result, that gain is going to be added in to the basis of the property. So the basis of Inc.'s property is the carryover basis, but as each dollar of gain is recognized, then that basis gets increased by the amount of the gain that's recognized. Okay, I don't know whether that made any sense or not. Holy cow, that's hard. Okay, so let's think about assumption of liabilities for a second. So in a like-kind exchange, debt assumption is treated as boot and could trigger gain recognition. And when I typically teach like-kind exchanges, I talk about how this is totally unfair because, of course, typically, if someone assumes away your debt, that's great, but you don't end up with any cash. And as a result, you don't really have the cash to pay taxes. So contrary to the ability to pay concept, but all the same, that is the rule. The good news is that under 357, typically, if you have a 351 exchange and the transferee is having some liabilities assumed away from them, that is not treated as boot. But it does reduce their basis in the stock. So basically, it's a trade-off. It's saying, look, we're not going to make you recognize gain on the debt that was assumed away and treat it as boot, but we are going to make you build that gain into the basis of the stock. So Brandon transfers property. His basis is $40,000. The fair market value is $100,000, and it's subject to a $30,000 mortgage. So he exchanges that to Popcorn Inc. and gets back $70,000 worth of stock. So his realized gain is the $100,000 less the $40,000, or $60,000. There's no, so just to make sure we understand that, his amount realized is the $70,000 worth of stock plus the $30,000 of liabilities assumed. So just to be clear, that's the $100,000. There's no recognition, right, since the liabilities are not treated as boot under 357A. However, his carryover basis of $40,000 is reduced by the liabilities assumed of $30,000. So his basis in his stock is only $10,000. Whereas Popcorn keeps the full basis at the carryover basis amount of $40,000 because, of course, they just inherited a liability to go with it. There are two exceptions to the liabilities are not boot rule. The first is under 357B, and that's just a tax avoidance rule. The second one is under 357C, and that's when the liabilities assumed away are in excess of the basis of the transferred property. All right. So let's deal with tax avoidance first because this is just a trap for the unwary, right? So this is just to prevent cheating. So a liability is treated entirely as boot if the taxpayer's principal purpose in transferring liability was the avoidance of federal income tax or was not for a bona fide purpose, right? Bona fide would be measured at the corporate level. And the idea is what we're trying to avoid is a 351 cash bailout. Okay, so let's say that I have a building and I'm about to contribute it to a corporation, and that building is subject to or is not subject to a liability. Well, I know that one of the things that happens is under 351, if I get back anything but shares, I have to recognize gain, right? Because that if I get cash back, for example, that's treated as boot. So what if instead, right before I transfer that building, I take a mortgage out against it, right? And so what happens is now the cash is in my pocket. Now I transfer the building to the corporation and it assumes the mortgage from me. That's a 351 exchange as long as it doesn't exceed the basis under 357C, I'd walk away with cash in my pocket. That's the cash bailout that they're trying to avoid with this. And a lot of it depends on, how recently did you borrow against that? And what did you do with the cash? And does it look like a sham transaction? So the other way is 357C, and this is when liabilities are in excess of tax basis of the transferred property. So you measure this as the total of the liabilities and the total of the bases of all the assets transferred. And the excess is treated as a gain from the sale or exchange of the property. So there is a minor exception when those liabilities would have been deductible when paid. And basically think of this as like, if it's subject to accounts payable, we're trying to make sure that we don't trigger a gain for a cash basis taxpayer. You don't need to worry too much about 357C3. Brandon transfers property. Basis is $10,000, fair market value $100,000, subject to a $30,000 mortgage. And that's in exchange for the $70,000 worth of stock. The difference is between the previous version is now the mortgage, the liability assumed, exceeds his basis. So his realized gain, 100,000 minus 10,000, is 90,000. He needs to recognize that gain to the extent of excess liabilities. So what that means is his excess liabilities are 20,000. He's going to recognize all 20,000 of that, and his basis in the stock is 0. And this makes sense when you think about it, because his deferred gain is 70,000, right? His realized gain was 90. He was forced to recognize 20. The deferred gain is 70. The fair market value of the stock is 70. So if he sold it today, he'd recognize all of it as a gain. Okay. So again, 357C is based on aggregate excess. So if you had two properties with a basis of 10,000 each that were transferred, only one of them was subject to a liability of 30,000. The gain would be 30,000 minus 20,000 because that's the aggregate basis. So you wouldn't have to look at it like, oh, that one property had 20,000 in excess of basis. No, you look at it in the totality of all the property. So there is a method out there that is presumed to solve this assumption of liabilities problem. So one way you could do it is just contribute cash, right? So put enough cash into the exchange so that you bump the basis up, because cash is always at basis, so that the liability is no longer in excess of the basis. That would be one way. So there's this other way that was developed by a guy named Parachi, and he contributed a note. And he said the face amount of the note is at least equal to whatever the negative basis is, right? So in this case, the real estate was subject to debt, and it was a big debt. So he accompanied the property with a note for over $1 million, $1,060,000. So Parachi contributes real estate to a wholly owned corp. The real estate is subject to debt that was in excess of his basis. So he also contributes a promissory note. The court decided that the face value of the note was the tax basis of the note. And as a result, it was not a sham. The IRS stipulated that the note had to have a business purpose, as in Parachi's case it did. And of course, he needs to remain personally liable for the debt. But in this case, he avoided recognizing any sort of gain because of this note. Now think about it. This is a wholly owned corporation. He contributes a promissory note to his wholly owned corporation. Does he ever have to pay the promissory note? Can the corporation ever come after him? You see what I mean? So amazingly, this is a trick that got through. However, I will warn you, the state of California does not permit the contribution of a shareholder promissory note in a 351 exchange. You can't even contribute a note to a corporation and have it count. That's actually under corporate law in California, not legal. Okay. We're not going to get too mixed up in contingent liabilities. There's a really cool case called Coltec that you could read. I'm not going to make you guys read it. It has to do with contributing high basis asset to a sub with contingent liabilities, and then trying to treat it so that the liabilities are not liabilities under the tax code. If you ever are really interested in this and you have Professor McKenzie, Coltec is a predecessor to Goodrich. And Goodrich is where she worked for years and years as their in their tax department. So she is intimately familiar with Coltec. Okay, so at the end of the day, what we have here is this promissory note, the Parachi scheme. There's still some risk associated with that. So even though the tax court approved it, I think, taxpayer beware. And Congress still really struggles to figure out what to do about the contribution of property subject to liabilities. 357B, which is the sham transaction. Wow, that's pretty loose tax law. So the liability in excess of basis, that's at least easier to capture and understand. But this is an area that's still rife for abuse by taxpayers and is as a result often abused. Okay, let's talk about this 80% control rule. So 351 and 368 both require control, and control is defined as 80% of the voting power of all classes entitled to vote, so 80% of all voting shares, and 80% of the total of all other classes of stock. So for number one, the idea is you have to segregate stock into voting and non-voting, and then determine if voting power is at least 80% for the people who contributed. For number two, it's 80% of each class of stock as a result. Okay, so if there are several transferors, that doesn't have to all happen simultaneously, but there should be an integrated plan. So the safest way to deal with this is, if you have a deal where you're organizing a corporation and someone contributes cash and the other person contributes property, but they need to close the sale of the property or they need to get rid of a lien or whatever it might be, and it doesn't all happen simultaneously, that's okay, but you really probably ought to have a plan. That plan ought to be documented. It probably ought to be written. And of course, it needs to happen with a speed consistent with orderly procedure. Okay. More than one transfer is absolutely okay. You look at the control of all the transfers as part of the integrated transaction. So A owns 100% of Inc., and B wishes to contribute highly appreciated property to Inc. But of course they want to avoid gain recognition, right? So if this was a sale, if they were just going to sell it to Inc., of course they'd recognize gain. That would be a problem. But in this case, they want to try to avoid that. So what do? You say, well, let's see if we can make it a 351, right? That's the best way. So B contributes a bit of property, and A contributes just enough property, right? Property of minimal value so that they're jointly going to achieve control after the exchange. So again, this is the same rule that we've seen. If that contribution is excessively small, then it's not going to count as property. So if A's contribution of property was less than 10% of the value of the stock A already owned, it's not going to count. A's contribution won't count. B would need to recognize gain. Okay. Again, doesn't require simultaneous exchange. These rules are saying, look, interdependence is important. If the exchange happened within hours of each other, it could be denied, whereas exchanges over a year apart could be accepted as immediately after. It's all about this orderly procedure and previous definition, right? So if you end up doing 351 and it's not all at the same time, you got to make sure you have a documented plan. Dispositions of stock are not terrible necessarily afterward. So let's say that I exchange property for stock in a corporation, and then immediately after I sell that stock, right? That doesn't necessarily taint my 351, but it would if that was pursuant to a binding or prearranged plan. So I went in knowing full well that's what I was going to do. Well, that's just a hidden sale, and they're not going to let that fly. Voluntary disposition. So if I get some and then I give it to charity, that generally doesn't taint the 351. So in the instance where I got just above, or I got just 80%, and then I gave a share away, which would have dropped me down to 79.99%, but I gave it away to a charity voluntarily, that's not going to taint my 351. You always have to be aware of step transactions, right? And to the extent they're mutually interdependent. And we talked about that in a previous slide when we talked about the step transaction theory. Okay. So what is the basis you take in the stock? It's generally the same basis as your transferred property. So transfer gives property with a basis of $4,000 for stock worth $8,000 plus cash worth $1,500 and property worth $500. So you'd say, okay, well, what would the basis be? It'd be carryover plus gain minus boot, or $4,000. But we need to allocate the basis away, because think about it. I got more than just stock, right? So this gain that I have to recognize of $4,000 doesn't necessarily all get to belong to the stock, right? So the rule is, look, basis is always, cash is always at basis. So I can't attribute any of the gain to the cash, because the $1,500 worth of cash is always worth $1,500. The stock would take the computed basis of $4,000, and what would happen is I would take the basis of the other property at $500, because that's the fair market value that triggered the gain. All right. We talked about liabilities and did that example already. Basis generally carries over to the corporation as well. To the extent the transfer recognizes gain, they get an increase in their basis. So there's a special rule that if a parent corporation contributes shares of its own stock to a sub-corporation, the shares are considered property, so it can be a 351, but they're assigned a basis of 0. All right, let's take a little break and we'll do part two in a few minutes.